Section 3. Don't be lazy, be very lazy. If you have come this far, I hope you have been nodding your head in agreement more often than cursing the reviewers who persuaded you to buy or borrow this book. What's not to like about avoiding significant risks and buying high-quality businesses? Of course, you and I can quibble about how much weight to give management meetings, whether 20% ROAS is acceptable or at which stage of a turnaround one should invest. However, suppose you are a long-term investor or desire to be one. In that case, I am assuming we agree directionally taking on avoidable risks is bad and investing in great businesses is good. Alas, our bonhomie may not last beyond this page. When it comes to buying and selling businesses, we are not just lazy. We are very lazy. We rarely buy and seldom sell. Many, probably most, long-term investors ultimately sell their investments, especially when the price is egregious. We don't. We are permanent owners. We will not sell a single share in a business we love. There are some minor caveats to this, which I will get to, but while some of you may accept the notion of buying rarely, the thought of never selling may seem wrong, even foolish to you. That's all right. My task in this book is not to tell you what you should do, but to share what we do. Chapters 8 and 9 invoke two relatively unknown tenets of evolutionary theory to bolster the case for buying rarely and selling even more rarely. Chapter 10 focuses on selling, or rather not selling, by elaborating on a well-known but underappreciated concept that unites evolution and long-term investing. Finally, I conclude the book by highlighting a key lesson for investors from evolutionary theory. A simple process can lead to a stellar outcome. I end with rabbits and honeybees. But we must begin with birds and bears. Chapter 8. Birds and bears bear an aberration. It may be said that natural selection is daily and hourly scrutinizing, throughout the world, every variation, even the slightest, rejecting that which is bad, preserving and adding up all that is good, silently and insensibly working, whenever and wherever opportunity offers, at the improvement of each organic being in relation to its organic and inorganic conditions of life. Charles Darwin, On the Origin of Species, Chapter 4, Natural Selection. Despite the difficulties we have had in reserving and the commodity economics of the industry, we expect our insurance business to both grow and make significant amounts of money. But progress will be distinctly irregular and there will be major unpleasant surprises from time to time. Warren Buffett, Annual Letter to Shareholders, 1986. The island looked like a war zone, and one side had lost badly. The carcasses of dead birds were strewn everywhere. Peter Bogue and Laureen Ratcliffe returned to the island in January 1978 and found that almost 80% of the birds had succumbed to the drought of 1977. Only about 290 were alive. They searched for their favorite bird, a female who had followed them around the camp in 1977, but they could not find her body. Of the two main species of birds on the island, Fortis was especially hard hit. In 1977, not a single Fortis laid an egg or built a nest, so no Fortis babies were born. Also, every Fortis born the year before the drought in 1976 had perished. Peter and Laureen took careful measurements of the dead and the living birds and went to Princeton to tabulate their findings with a heavy heart. The results were astounding. Had they proven Darwin wrong? What unites Fed rates, Chinese ports, and German regulators? One of the biggest Bollywood blockbusters of the 1970s was Roti Kapta or Makan, bread, clothes, and shelter. Over more than 2.5 hours, yes, Bollywood movies can be lengthy, of non-stop melodrama, the film dwells on the importance of the lowest rung of Maslow's hierarchy of needs. If it were to be made today, it would be named Wi-Fi, Roti, Kapta, or Makan. To me, the pre-internet era seems unimaginably dull. But then there was always a lot happening in the world. The difference now is that I am made aware of it with barely a second's delay. For a hospital nurse, a chocolate salesperson, or an automotive engineer, the flood of nonstop news can be like background noise. They have the option of tuning in or out of it depending on their mood and the amount of free time they have. Some may choose to obsess over specific topics on social media, but their jobs and the general news flow are denizens of non-overlapping worlds for most of them. Not so for investors. Most will tell you that the flow of news, especially business news, is a critical input for their decision-making. So it would be highly unusual not to find CNBC playing on mute in their offices or a shiny Bloomberg terminal with scrolling news stories on their desks. Why? Let me explain by sampling some headlines from the June 22, 2021, online edition of the Financial Times. Wall Street rebounds as markets adjust to Fed rate rise outlook. COVID outbreak at Chinese port exacerbates global supply chain delays. German regulator launches antitrust probe into Apple. Emerging markets are right to worry about capital flows. Solar power investors burnt by the rise in raw material costs. Did your heart start to beat faster by the time you reached the headline on solar power? Knowing my industry, I am sure that many investors reacted to one or more of these news items by making small but significant changes to their portfolios. Start with the first news item on the Fed rate rise outlook. Remember the discounted cash flow (DCF) models we encountered in Chapter 5? I bet that most investors worldwide, not just in the United States, would have adjusted their DCF models to reflect the potential change in rates. The US dollar is the world's currency, and any interest rate movement in the United States is vital to any country's interest rate. I don't know if this is actually so, the issue is too esoteric for me, but I do know that it is seen to be so. My inbox receives detailed commentary from Indian analysts whenever the US Fed tinkers or threatens to tinker with the interest rate. And what happens when someone changes the discount rate of their model? The stocks appear cheap or expensive, which is a trigger for buying or selling. A newspaper headline about the U.S. interest rate triggered stock market activity across the world. Let's take the second headline about the COVID-19 outbreak at a Chinese port. The article discusses the closure of Shenzhen port in China, one of the world's largest container terminals, for a week after some workers tested positive for COVID. We learn that the container freight rate has quintupled since the previous October. A clothing factory owner in Guangzhou laments that the situation is like a nightmare. For her, it certainly is. But should it be for investors? It almost certainly was. I would not be surprised if the shares of companies in the following industries witnessed frenetic activity after this news: container shipping companies, shopping manufacturers, ports, clothing manufacturers, logistics companies. Companies anywhere in the world that import a lot of products from China, and companies anywhere in the world that don't import a lot of products from China. After all, wouldn't they be saving money compared to those who do import from China? A headline about a Chinese port triggered stock market activity across the world. Last one. Why should a German regulator launching an antitrust probe into Apple affect the stock prices of companies other than Apple, you ask? It is not inconceivable that the stock price of quasi-monopolies like Amazon, Facebook, Google, and Twitter would have reacted to this news because fund managers in the United States and elsewhere decided that a Rubicon had been crossed owing to the action of the German regulator. And this would have led to a zillion buy or sell orders depending on whether fund managers thought it was a good or bad thing for their portfolio holdings for consumer technology and media businesses. If it could happen in Germany, why not in any other country? A headline about a German regulator's action on a U.S. company triggered stock market activity across the world. All right, I know. I am on thin ice here. Without offering proof, I am claiming that fund managers bought and sold stocks globally in various businesses based on these three pieces of news. I have no idea if my specific claim about these three news items is valid, but there is no denying that mutual funds have become more trigger-happy over the years. According to a 2018 Morgan Stanley report titled Long-Term Conviction in a Short-Term World, the average holding period of mutual funds had fallen to less than 1 year from 7 years in 1960. Funds are not being bought and sold in a vacuum. Fund managers decide to buy or sell based on something. Often that something is the latest news from a highly reputed and reliable financial newspaper. I will let you figure out the impact of the two remaining news items on my list. They were on emerging market capital flows and the rising raw material costs in the solar power industry. It shouldn't be too hard. Based on what I discussed in Chapter 4, Proximate and Ultimate Causes of Success, and the title of Section 3, which advises to be very lazy, you will correctly conclude that we did not react to any of these 5 pieces of news in June 2021. Our activity was zero. But couldn't we have been wrong? Why should I not have adjusted my Indian portfolio based on the Fed's interest rate outlook? Many of our portfolio companies import goods from China. Shouldn't we have sold them since their profits were certain to get squeezed? And why didn't we tinker with even one of our 3 internet businesses, which enjoy a virtual monopoly in their respective markets? After all, couldn't the Indian regulator have followed the footsteps of its German counterpart? And what could be more worrying for us than the specter of declining capital flows to India? I will get to these answers, but before that, let's examine a different kind of news flow that hits much closer to home and is much harder to ignore. Unceasing upheavals can be upsetting. We have seen the potential stock market effect of only a few news items on a single day from a single newspaper. Yet this phenomenon repeats itself day after day, actually moment to moment, across newspapers, TV channels, social media platforms, whispers from brokers and fund managers, and heaven knows what else. Notwithstanding special purpose acquisition companies, SPACs, and WeWork, fund managers invest in real businesses with real money. Instead of studying generic news as we have just done, what if we track the news flow of a single company over time? Let's do a brief thought experiment. Assume you are a long-term investor. In early January 2009, in the middle of the global financial crisis, you chose to invest in the French company L'Oréal, the world's largest and most successful cosmetics company. Your view was that a quality business like L'Oréal should be able to overcome any short-term pains owing to the financial crisis. You paid about €60 per share. Because you are a long-term investor, you plan to own the business for many years. Over the next few years, apart from the company's quarterly and annual financial results, you will also be bombarded with a wide range of news on the company. Table 8.1 provides 5 headlines for L'Oréal from various news sources from every year from 2009 to 2021. Before reading further, please take a quick look. Done? Okay, first question. Would you have stayed invested at the end of 2009? All 5 headlines look worrisome. Let's look at 3 of them. First, eBay seems to have scored a significant victory over L'Oréal in the UK courts, which ruled that eBay was not responsible for any counterfeit products sold on its website. Could this ruling lead to L'Oréal losing the e-commerce race? Second, even more worrisome, the Danish Consumer Council declared that Biotherm, a L'Oréal skin product, contained harmful substances. What kind of reputational and real damage would the company suffer in other parts of Europe? Third, L'Oréal's chair is embroiled in a legal battle among the family members who own L'Oréal. Sir Lindsay Owen-Jones, the chair, had allegedly received about €100 million from Liliane Bettencourt, who owned 31% of the company in return for his long service. As an investor, should we be worried that the chair might be distracted, given the public nature of the feud? Let's examine the potentially damaging events of 2011. The regulator has fined L'Oréal for price fixing and banned many of its advertisements, and the financial results for the second quarter clearly show that the company has been unable to pass higher costs on to consumers, thereby suffering lower margins. Does this indicate that L'Oréal is finally losing its brand power and that the competition has caught up? Owen-Jones has resigned abruptly, although his term wasn't expiring until 2014. He was widely acknowledged as the key driving force behind the company's global success and was one of France's most respected business leaders. He delivered double-digit profit growth for almost 2 decades when he was the company's CEO from 1988 to 2006. Should you be selling your stake in L'Oréal because it will be hard for a new leader to emulate him, or should you be buying more if the price reacts negatively? As you glance through Table 8.1, you will notice dozens of such news items that point to a potentially significant event in the company's life. Some may even seem self-contradictory. For example, in August 2013, L'Oréal made an aggressive bid to acquire a Chinese company. But by January 2014, the company appears to have pulled back from China by stopping the sale of its Garnier brand. Then, in June 2015, the company cut prices aggressively in a blatant attempt to gain market share. We don't invest in France, but if we did, should we have reacted to these headlines? If not, why? And if so, how? By studying Kurtén's bears and Darwin's finches. Evolution is not what it seems. The metaphor, never judge a book by its cover, should also apply to bland research articles with titles like Rates of Evolution in Fossil Mammals. Contrary to what you would expect from this title, this article, in my layperson's opinion, is one of the most exciting in the history of the development of evolutionary theory. In 1959, exactly a century after the publication of Darwin's Origin, a Finnish scientist named Björn Kurtén published this article in a biology journal. Instead of celebrating Darwinism's centenary, Kurtén poked a seemingly large hole in it. To comprehend Kurtén's stunning claim, we need to revisit Darwin's assertion in Origin. I do believe that natural selection will always act very slowly, often only at long intervals of time, and generally only on a very few of the inhabitants of the same region at the same time. I further believe that this prolonged, intermittent action of natural selection accords perfectly well with what geology tells us of the rate and manner at which the inhabitants of this world have changed. As we learned in Chapter 5, Darwin was inspired by the famous geologist Charles Lyell, who proposed the theory of uniformitarianism. Lyell contended that the Earth has slowly and uniformly changed over the millennia and that understanding the present is key to interpreting the past. He directly contradicted the prevailing theory of catastrophism, which suggested that the features of the Earth, like mountains, resulted from extensive and sudden changes or catastrophes. Darwin applied Lyell's theory of geological evolution to the biological world. He believed that just as the Earth evolves slowly over very long periods, so does the world of animals and plants. The upshot of Darwin's insight is that if we were to measure the pace of evolution, it would correlate proportionately with the measurement period. It would be slow over brief periods and fast over long periods. Darwin's theory stressed that species evolve slowly. This idea was gospel until Kurtén's article was published in 1959. Kurtén plotted the evolution of the length of the second lower molar of the brown bear in Europe during the Pleistocene epoch between 2.6 million and 11,700 years ago. Let's examine the data in Table 8.2 for the rate of change of the molar measured in Darwin's 1. Darwin is a change of 1 upon 1,000 in 1,000 years and the period of measurement. Do you see a trend here? Kurtén's data show that evolution appeared to occur quite quickly when measured over short periods and slowly when the measurement period was prolonged. Thus, when measured over 400,000 years, the rate of change of the molar was 0.41 Darwins, but over 8,000 years, the rate of change was an astounding 13.8 Darwins. He demonstrated a similar trend in other fossilized mammalian species, including horses. I was incredulous when I first read about Kurtén's conclusion. Suppose we accept the Darwinian notion that the current diversity of the world is the result of species transforming slowly but surely throughout the eons. How is it possible that the pace of evolution is slower over more extended periods and faster over shorter periods? Kurtén's article was not an outlier. In a 2009 article titled Rates of Evolution, Philip D. Gingerich, a paleontologist at the University of Michigan, also supported Kurtén's claim. He demonstrated mathematically and empirically that phenotypic change, that is, changes in the bodily characteristics of a species, could be rapid from one generation to the next. In contrast, evolution can be slow on long timescales. Does this inverse correlation between the rate of change of bodily parts and the time interval of measurement also apply to genes? It does. Simon Ho, an Australian evolutionary biologist, and his colleagues provide an excellent overview of this seemingly un-Darwinian phenomenon in their 2011 article, Time-Dependent Rates of Molecular Evolution. They summarized the research done by several scientists on the genomes of humans, insects, birds, fish, and even bacteria and viruses. Most of this research points in the same direction. Contrary to expectation, the pace of genetic evolution is inversely correlated with the period of measurement. The grants take it one step further. All the research studies mentioned so far have examined evolution over hundreds or thousands of years. Do these conclusions also apply over a few years or decades? We now return to Peter Bogue and Laureen Ratcliffe, who had been stunned by the result of their analysis of Darwin's finches, both dead and living. On the small island of Daphne Major in the Galapagos, they witnessed what no one had seen before: natural selection and evolution occurring in real time in two species of finches. As Bogue stated in his famous 1981 Science article, the intensity of natural selection in the birds was the highest yet recorded for a vertebrate population. Fossils show that evolution has occurred, and Darwin's irrefutable logic argues that natural selection can drive evolution. However, no one had ever seen natural selection and evolution in action. Darwin didn't think it was even possible. In 1893, the German evolutionary biologist August Weismann wrote, "It is very difficult to imagine this process of natural selection in its details, and to this day it is impossible to demonstrate it in any one point." Author's emphasis. In their book, The Variation of Animals in Nature, the British evolutionary biologists Guy C. Robson and Owain W. Richards wrote in 1936 in Darwin's treatment of the subject, "No proof is adduced that a selective process has ever been detected in nature. It is a very unsatisfactory state of affairs for biological science that a first-class theory should still dominate the field of inquiry, though largely held on faith or rejected on account of prejudice." The unsatisfactory state of affairs had finally ended. Bogue and Ratcliffe's observations changed the field of evolution forever. They were part of a long-term project started by Peter and Rosemary Grant, a married British couple and currently emeritus professors at Princeton. The Grants wanted to study evolution in the wild and discover the key factors that lead to new species. So they decided to study Darwin's finches, also called Galapagos finches. Figure 8.1 provides illustrations of 4 species of finches, out of a total of 14, that have adapted and evolved from one mother species that landed on the Galapagos Islands 2 to 3 million years ago. The Grants landed on the island Daphne Major in 1973 to start their project. As I shared in Chapter 5, Darwin had visited the Galapagos in 1835. The Galapagos group of islands is almost 1,000 kilometers off the west coast of Ecuador. Owing to its remote location, it is home to several endemic species, that is, species not found anywhere else in the world. There are about a dozen central and minor islands in the archipelago. Daphne Major is small, nondescript, and remote even by the standards of Galapagos. Darwin did not even see it and measures barely a square kilometer in area. The next time I feel like complaining about the firmness of the mattress or the softness of the pillows in a hotel room, I hope I remember what the Grants endured on Daphne Major for 6 months every year for 40 consecutive years. Before the Grants and their research staff made it their home, no humans had lived there. How could they? There is only one way to enter the island, and that is the base of a cliff, since the island has no shoreline. To set up their camp every year, here's what the Grants had to do. They had to abandon their boat as they neared the island and approached the cliff base at low tide in a rowboat called a panga. A single black ledge filled with barnacles was their only landing point. It's the size of a large exercise mat. They needed to leap onto this mat while the panga swayed wildly in the ocean waves. From here, they had to walk up the cliff on hard, wet rocks until they arrived at another ledge that they called the landing. Then they formed a human chain and passed up tents, poles, water, food, and everything else they would need for the next 6 months. Daphne Major has no water or food. They could pitch their tents only at one spot, which was the size of a table and on the rim of a volcano. They had to lug all their supplies there from the base of the cliff. They cooked their meals in a small cave protected from the harsh sun by a sheet of cloth. Once settled, they would spend the next 6 months measuring the body size, and beak shape of every finch on the island. They would also extract blood to do a genetic analysis. Why would anyone in their right mind spend time on such an island? Because it offered many advantages that few other places could. Daphne Major was so far removed from the other islands that there was only a minimal chance that the finches or other island species could escape or that new ones could arrive. It was a perfect petri dish for evolutionary studies, because it would not get contaminated. Also, the Grants realized that the Galapagos were a gold mine for testing and refining Darwin's theory. The Galapagos Islands undergo extreme climate swings, from severe drought to copious rain, thereby providing ample opportunity for natural selection. Last, Daphne Major was small enough to track every bird that lives there over many years, which they did. From 1973 to 2012, the Grants tagged about 20,000 birds over 8 generations, and they tracked almost every copulating pair and their offspring. In the first 4 years of their study, from 1973 to 1976, the island received average or excess rainfall. But in 1977, after a brief spell of rain in January, Daphne Major suffered a severe drought. Almost all the greenery disappeared from the island, and the only plants that survived the drought were cactus bushes. The finches fed on seeds of all sizes. The small and medium-sized seeds disappeared very soon, and the finches were then left with only large and hard seeds. But only the finches with larger beaks could break open these larger seeds. Finches with small and medium-sized beaks could not open these seeds and so starved and perished. The island was inhabited mainly by 2 species. At the start of 1977, there were about 1,200 Geospiza fortis and 280 Geospiza scandens. By the end of the year, only 180 fortis and 110 scandens were left. About 85% of the fortis and 60% of the scandens had succumbed to the drought. The Grants' data showed that the surviving fortis were, on average, 5 to 6% larger than the ones that had died. The average beak length of the survivors was 11.07 millimeters compared to 10.68 millimeters for the species before the drought. The average beak depth had increased from 9.42 millimeters to 9.96 millimeters. These differences may appear small to us, but they can tilt the balance between life and death in the wild. For example, a fortis with a beak length of 11 millimeters can crack a seed from a plant called a caltrop, but an individual with a beak length of 10.5 millimeters will not even attempt to do so. Just half a millimeter can make all the difference. The intensity of natural selection the Grants observed wasn't limited just to beak length and depth. At the start of 1977, there were 600 male and 600 female fortis. By the end of the drought, more than 150 males and only a few females were alive. The males are typically larger than the females by about 5%, so the males were more likely to survive. There were now 6 males to every female. Natural selection can occur in a single generation, but evolution takes place only over many generations. Given the dramatic change in the beak size and sex ratio of the finches, natural selection had happened. But what about evolution? The Grants had to wait one more year to measure the beak size and shape of the offspring of the drought survivors of 1977. But then they saw evolution in action too. The new generation was 4 to 5% larger than the population before the onset of the drought. They soon realized that their observation of 1977 was not a fluke. In 1983, there was a very heavy rainfall because of El Niño, and the island became lush and green. Green vines covered even the cactus bushes. This changed vegetation had a significant impact 2 years later when drought struck again. This time, tiny seeds were abundant, produced by the vines of 1983, and large seeds became rare. As a result, the finches with large beaks found it hard to pick up the seeds, and a large proportion of the survivors of this drought were the small-beaked finches. Their offspring, as a result, also had smaller beaks. Natural selection and evolution were evident again, except that, unlike in 1977, the beaks had evolved to become smaller. Thus, in less than a decade, the finch's beak size increased and then decreased because of natural selection. When observed over a decade, beak size may not have appeared to change that much, but it had fluctuated significantly in the intervening period owing to the 2 extreme climate events. The Grants published the results of their long-term study of the evolution of the 2 species of finches, Fortis and Scandens, in Science in April 2002 under the title Unpredictable Evolution in a 30-Year Study of Darwin's Finches. Before starting their research, they had hypothesized that the body traits of the finches would vary within a narrow band over the period of the study. But as they say at the beginning of the article, the data do not support the expectation of no change. If you examine the graphs of the body size, and beak shape of Fortis and Scandens in the Grants article, you will notice the inverse correlation between the measurement period and the pace of evolution pointed out by Kurtén in Brown Bears. Thus, while the body size of Fortis fluctuated a lot between the mid-1980s and the early 2000s, the overall change over those 2 decades was small. Similarly, the annual variation of the beak size of Scandens appeared to be much greater than the variation from the mid-1970s until the early 2000s. The beak shape of Fortis was practically the same when measured in the mid-1980s and the early 2000s, but its annual change was much more significant. There is a lovely fractal-like property to this phenomenon. It does not seem to matter if the measurement period is thousands of years, bears, or just a few decades, finches. The pace of evolution speeds up over shorter periods and slows down over more extended periods. But so what? Why should long-term investors care about Kurtén's bears and the Grants' finches? The Grants and Kurtén dictate when we buy and sell. My observations are nowhere as scientific as the Grants or Kurtén's. However, I know that the daily, weekly, monthly, and quarterly rate of change in exceptional businesses appears much greater than the rate of change measured over years and decades. This realization has helped me formulate an investing principle that I call the Grant-Kurtén Principle of Investing, GKPI. It goes as follows. When we find high-quality businesses that do not fundamentally alter their character over the long term, we should exploit the inevitable short-term fluctuations in their businesses for buying and not selling. GKPI requires us to own high-quality businesses that do not fundamentally alter their character over the long term. High-quality businesses is a loaded term and can mean different things to different investors. If you have come this far, I assume you know our definition. For us, the critical character traits of a high-quality business are stellar operating and financial track records, a stable industry, a high governance standard, a defensible moat, increasing market share, and low business and financial risk. How do we use GKPI for buying? By exploiting short-term fluctuations. We are highly demanding. We want a company to be run by an honest management team and show solid operating and financial track records over many years. It needs to stay ahead of the competition and be debt-free, and we also want it to keep taking calculated risks while not unduly burdening the business. And as if all these demands were not enough, we dare to insist on a fair price for these rare gems. How is this even possible? The market should almost never offer us an attractive price for such a business, and it doesn't. However, on rare occasions, investors who don't subscribe to GKPI succumb to the pressure of temporary macro, industry, or company issues, and we can then swoop in to buy a piece of an exceptional company. It doesn't and shouldn't happen often, but when it does, we go all in. Take WNS, one of our largest investments to date. It is one of India's leading business process outsourcing (BPO) companies and is listed on the New York Stock Exchange. It was set up in 1996 as a captive back office by British Airways and started serving third-party clients in 1999. In 2002, Warburg Pincus acquired a controlling stake in WNS. I wasn't involved in the deal. Although British Airways contributed to about 90% of WNS's revenues at the time of acquisition by Warburg Pincus in 2002, its revenue share had fallen to less than 10% by early 2008. The management at WNS had done a stellar job of diversifying away from British Airways and the travel industry. By outsourcing back-office functions like finance and accounting, mortgage processing, and customer analytics, WNS's clients typically get higher quality service, example, faster turnaround times, lower error rates at a much lower cost. In January 2008, the stock price of WNS fell sharply from a previous high of $35 to $13. Three factors seem to have contributed to this steep correction. First, one of its large mortgage lender clients, First Magnus, declared bankruptcy in late 2007 owing to the ongoing subprime mortgage crisis in the United States. First Magnus had contributed to about 5% of WNS's revenue, so the management lowered its revenue guidance for the next year. Second, the management indicated that it may lose Aviva, a large insurance client that was contributing to about 8% of WNS's revenue by May 2008 if Aviva were to acquire the WNS facility servicing it. And third, the appreciating rupee had the analysts worried since most of WNS's delivery presence was in India. A stronger rupee could make WNS less competitive and squeeze margins. The question for us was this a temporary blip, or was it a more permanent decline of achievable revenue and profit growth? We decided it was the former. The loss of First Magnus wasn't WNS's fault, and even the potential loss of Aviva would be due to Aviva's change of strategy, not because WNS wasn't serving it well. Also, we didn't believe WNS's long-term competitive advantage would be adversely affected by exchange rate fluctuations. WNS's annualized revenue growth of 64% from 2004 to 2007 was proof that it offered high-quality back-office processing services to its clients at competitive prices. Also, we love the Indian BPO industry. It is lucrative for well-established incumbents because it has high entry barriers for new entrants. Businesses are extremely wary of outsourcing their mission-critical applications to a startup and high exit barriers for existing clients. WNS and other leading players almost never lose a customer given the sticky nature of back-office processing. I assume you have heard the song Hotel California by the Eagles. The song's last line, "You can check out any time you like, but you can never leave," applies to the clients of the leading companies in Indian BPO industry. WNS was and is in a great place. The bottom line was that despite the market pessimism, we had no reason to believe that anything fundamental had changed at the company. We bought aggressively and invested $41 million in early 2008 at an average price of $15.20 per share. By March 2022, the stock price, $85.50, had gained 462%, whereas the Indian indexes, the Sensex as well as the Midcap Index, had gained only 97% in dollars. Then, almost exactly 12 years after our initial investment in WNS in early 2008, we got an opportunity to buy again during the early days of pandemic panic from March to May 2020. We invested an additional $98 million in the business at an average price of $46.10 per share just when the markets seemed to think that the world was ending. Some gifts just keep on giving. How do we use GKPI for selling? By ignoring short-term fluctuations. If we get lucky by owning a high-quality business like WNS, GKPI requires us not to sell. Why? Because, as shown by the Grants and Kurtén, short-term changes do not usually impact the long-term character of an exceptional enterprise. Let's revisit L'Oreal to marvel at the beauty of GKPI. Table 8.3 provides a snapshot of the business in 2009 and 2020. If you go through the annual reports for these years, you will get a sense of déjà vu. The language, the tone, and the business focus seem eerily similar even though 11 years separate the two commentaries. Although the company's sales grew from €17.5 billion to €28 billion during this period, it remained a global beauty business that derived most of its revenues from Western Europe and the United States. There were no unrelated diversifications, and the company did not make any significant, risky acquisitions. Its four divisions, professional products, consumer products, luxury products, and active cosmetics, remained the same during this period. Its top two divisions, consumer and luxury, accounted for about 80% of sales. Even the critical brands across divisions remained essentially unchanged. L'Oréal continued to be a cash machine, which allowed it to become a cash surplus company in 2020 after being indebted in 2009. One significant change during this period seems to be the dramatic growth in Asia, mainly China. The revenue contribution from Asia increased from 13% to 35% from 2009 to 2020. But this was not a sudden change, as is evident from the trend of the company's Asian revenue contribution to total revenues from 2009 to 2020: 13%, 18%, 19%, 21%, 21%, 21%, 22%, 22%, 24%, 27%, 32%, and 35%. Aside from 2010 and 2019, Asia's revenue contribution inched up by only 0 to 3 percentage points every year, steady as she went. Let's revisit where you were earlier, back in 2009. You had bought L'Oréal stock for €60 per share. If you were a follower of GKPI, you would have ignored every piece of bad news listed in Table 8.1. Instead, you would have seen these news items for what they were: unimportant and irrelevant for the long-term performance of the business. In fact, at some points in this journey, you may have chosen to load up on more shares when you found the price attractive. Where do you think the stock price was at the end of June 2022? It was €329 per share. So your gain would have been 450%, which handsomely beat the French CAC 40 index, which grew only 80% during this period. This is not a recommendation to buy L'Oréal, but it is a tribute to the proper application of GKPI. You would have done spectacularly well by doing nothing. GKPI is our religion, and it reflects in all kinds of big and small ways in the way we work. Our office doesn't have a TV screen playing CNBC or any other news. Our lone TV screen is used only for video conferencing. The only Bloomberg terminal we have is in the corner of our office pantry. It remains unused and unwatched probably 99% of the time. We never discuss recent company news or share prices in our team meetings. I mainly read physical newspapers in which the information is always one day late. We have never bought or sold a single business based on news flow and never will. GKPI demands that we be lazy when buying and very lazy when selling. And so we are. It has led to some decent outcomes for us. In June 2022, excluding purchases during the previous 2 years, we owned 28 businesses. In one of these businesses, we made more than 100 times our money paid. In 2 of them, we multiplied our money more than 25 times, Burger and Ratnamani, and in 6 of them, we made more than 10 times our money in Indian rupees. Unfortunately, all 9 have suffered small but significant setbacks, some of which lasted many years, example, Ratnamani and Page. However, our adherence to GKPI ensured that we didn't panic, exercised patience, and stayed lazy. Why and when we sell? If GKPI requires that we not sell, then why do we? We don't sell on valuation, a key reason many investors throw up their hands and exit. That is because we have no target price for selling in our portfolio. I have sold on valuation. Only once. I behaved foolishly and regret it even today. I will discuss this folly in Chapter 10, so let's ignore it for the moment. We sell under the following 3 conditions. The numbers in parentheses indicate the number of businesses sold. 1. A decline in governance standards. 0. 2. Egregiously wrong capital allocation. 3. Irreparable damage to the business. 6. We have sold 10 businesses since 2007, the 9 listed here plus the mistake. I am excluding 3 businesses that strategic buyers acquired. This translates to 1 exit every 1.5 years. How's that for laziness? As you can see, 6 of our 9 exits occurred because we believed the business had been damaged beyond repair. And how did we come to that conclusion? An example can clarify. We had invested in an old-world manufacturing business that was the leader in an oligopolistic industry in India. It ticked all the boxes: enviable governance standard, impeccable financials, stable industry, zero leverage, and we were able to buy at what we thought was an attractive price. Everything was hunky-dory for the first couple years. However, in the third year of our ownership, we were surprised to see that the business lost market share for 2 quarters in a row. We spent time with the management to understand the reasons, and after some initial resistance, they agreed that there might have been some temporary share loss. However, they were confident that this was a transitory phenomenon. But it wasn't. The company kept losing market share, and in one of the smaller but highly profitable segments, its share loss accelerated over the next few quarters. Again, the management seemed to have a compelling set of explanations, all of which sounded logical. They claimed they had made many changes to their manufacturing, sales, and marketing practices and that we would see the trend reverse soon. But the loss of market share continued. We waited for 3 more years after spotting the initial trouble and finally decided to pull the plug. Since we want to be permanent owners, we demand a high-performance standard in both absolute and relative terms. When we exited, this business was delivering decent results, about 35% ROAS with modest revenue and profit growth. But we did not want to be owners in a business that consistently fell behind the competition. During those 3 years of waiting for the business to improve, several positive and negative news reports were made about the company. We ignored the news and focused on the trend in actual market share. Why did we hold the business for 3 more years after detecting the problem? Why did we not sell sooner? Because GKPI tells us that we should expect ups and downs in every business. There isn't a single business in our portfolio that has gone up in a straight line. Not one. Over the long run, most businesses in our portfolio have done well, but every business has gyrated wildly in both directions when measured over weeks or quarters. Our default option is to overlook these temporary business upheavals. However, in some cases, like the one I've discussed here, what we think is temporary becomes more permanent. Fortunately, there have been only 6 such occasions in our history. Therefore, our default option will always be to continue to respect GKPI. Remember that the maximum we can lose is our investment amount, but there is no limit to how high a share price can climb. Given the quality of businesses in our portfolio, we prefer to run the risk of selling late and losing some capital than selling early and foregoing substantial gain. A lot can happen over 60 years. Or can it? We apply evolutionary thinking by ignoring both small and big setbacks in our businesses to focus on the long term. Despite the L'Oreal example and our experience applying GKPI, the skeptical part of your brain should raise 2 valid questions. 1. How long is long term? And 2. Since new businesses keep destroying old ones, won't we be left with only failed businesses after a few decades if we keep holding on? A headline on the website of the American Enterprise Institute from October 2015 can help us answer these questions. It reads, Fortune 500 firms in 1955 v. 2015, only 12% remain, thanks to the creative destruction that fuels economic prosperity. The article goes on to list the 61 U.S. companies that had survived 60 years on the list. Contrary to the article's tone, which mourns the seemingly significant Schumpeterian destruction, I was pleasantly surprised that 61 companies had stayed on the list for 60 years. I would have guessed the number to be much smaller. The period from 1955 to 2015 was tumultuous and unpredictable for the United States and the world. Also, the world of 2015 seemed almost unrecognizable from that of 1955. During those 60 years, we witnessed the start and the end of the Cold War, the splintering of the USSR, the advent of the space age, the U.S. Civil Rights Act, the oil shock, the savings and loans crisis, multiple crises in the Middle East, the meteoric rise of China, the formation of the European Union, the internet boom and bust, the exponential growth of mobile phones, innumerable wars across the globe, the global financial crisis of 2008, the increasing dominance of technology firms, and the rapid digitization of all businesses. I haven't stated at least 100 more significant events that also would have impacted companies of all sizes in the United States. However, companies like 3M, Alcoa, Avon, Caterpillar, Kellogg, Pepsi, Pfizer, and many others did much better than simply endure these massive local and global shocks. They also prospered by maintaining their position in the top 500 companies in the country. But this number, 61, was understated. First, there was a factual error. The author missed 11 businesses that appeared on both lists, companies including Colgate-Palmolive, Corning, H.J. Heinz, and PPG. It was probably just an oversight. Thus, 72 companies should appear on both lists. The second reason for understatement was that the author did not count the businesses that had been acquired by a Fortune 500 business between 1955 and 2015. Let's take Gillette. In 2005, P&G acquired Gillette for $57 billion. Gillette remained a Fortune 500 business for 50 years after 1955. Its rank was 215 when it was acquired. Should we consider Gillette to be a failure? Was it creatively destroyed? I don't think so. I used their overpriced blades just this morning. Since it was a part of P&G, which was ranked 32 on the Fortune 500 list of 2015, I would also consider Gillette to be on the Fortune 500 list of 2015. United Technologies acquired Otis in 1975, and so Otis stayed on the list for 20 years after 1955. United Technologies was ranked 45 on the 2015 Fortune 500 list, and I could reasonably argue that Otis should be counted as a continuing business as a part of United Technologies. We can reach the same conclusion for businesses like Wrigley, Quaker Oats, Carrier, Best Foods, and McDonnell Douglas, acquired by the Fortune 500 companies Berkshire Hathaway, PepsiCo, United Technologies, Unilever, and Boeing, respectively. There are 73 companies like Gillette and Otis from the Fortune 500 list of 1955 acquired by the Fortune 500 companies of 2015. Here, I have also included the larger overseas acquirers like BP and Unilever, who, if they were in the United States, would have been a part of the Fortune 500 in 2015. Thus, 145 businesses from 1955 could be included on the 2015 list. 72 that survived and 73 that have become part of the survivors. From 1955, 63 companies either went bankrupt or were untraceable. Finding companies from the 1950s and 1960s is not easy. They were a part of the destruction process of capitalism. What happened to the remaining 292 businesses, 500 minus 145 minus 63, from the Fortune 500 list of 1955? They either fell out of the top 500 or were acquired by or merged with other companies. Does that mean that all of them failed? Some may not have done well, but many may have continued to survive and prosper. There are a lot of high-quality businesses that aren't in the Fortune 500, which, by definition, is a highly restrictive list. For example, Eaton ranked 189 in 1955 and fell out of the Fortune 500 in 2013. In June 2021, its market value was $60 billion. So I wouldn't label it as a failure. Also, it stayed on the list for 58 years after 1955, which is no mean achievement. Borden Chemical was acquired by the private equity giants KKR in 1995 and then by Apollo in 2004. Borden exists even today as part of Hexion Specialty Chemicals. USG, a building products company on the Fortune 500 list of 1955, was acquired by Knauf of Germany, revenue of €10 billion, $47 billion in 2018. If we assume that 20 to 25% of these 292 businesses were acquired or fell out of the Fortune 500 of 1955 but continued to successfully deliver their products and services, we get an additional 60 to 75 businesses from the 1955 list that have been successful. Thus, the summary of the longevity of the Fortune 500 businesses of 1,955 is as follows. 72 companies, 14%, continued to be a part of the Fortune 500 for 60 years. 73 businesses, 15%, became a part of a Fortune 500 business by 2015. 60 to 75 companies, 12 to 15%, continued to do well despite being acquired or falling out of the Fortune 500. 280 to 295, 55 to 60% of the firms on the 1955 list failed. In chapters 9 and 10, I present the results of a study of the change in stock prices of listed U.S. firms over 90 years from 1926 to 2016. It shows that about 60% of the listed stocks delivered less than U.S. Treasury returns over the 90 years. Hence, my estimation of a 55 to 60% failure rate over 60 years, as calculated earlier, is probably on the higher side. Anyway, let's stick with it. We can safely assume that the 1955 Fortune 500 businesses were high-quality businesses. Of course, they may not have been high quality strictly according to our definition. Example, some may have had modest debt levels. But there is no denying that they were extraordinary companies. They couldn't have become some of the largest businesses in the mecca of capitalism without being outstanding. We have seen that at least 30%, 72 plus 73 is equal to 145 of these continue to be high quality as evidenced by remaining in the top 500 for 60 years. If we include companies that may have done well over this period despite not being part of the elite 500 in the year 2015, about 60 to 75 businesses, we see that 40 to 45%, 205 to 220 of companies from the 1955 Fortune 500 list performed well over 60 years. This is not a small number. Capitalism and creative destruction do work well, but not that well. So here are the answers to the two questions I posed at the start of this section. First, long-term is genuinely long-term, at least 5 decades, maybe more. And second, new businesses do replace old ones, but at a far slower rate than we think. This brings us back to the lesson from the Grants and Kurtén. There is no point wasting time, energy, and brain power on worrying about day-to-day upheavals in high-quality businesses. They can be highly resilient over the long term. So why sell? Kodak was the Facebook or Google of its day. Just like these two current giants, you would not have found it easy to name the second player in photography. In 1976, Kodak held a 90% market share in film sales and an 85% market share in the sale of cameras. And today? Smartphones are synonymous with cameras. Kodak is effectively dead. Ironically, an American electrical engineer at Kodak, Steve Sasson, invented the first digital camera in 1975. If we were analyzing Kodak in 1975, we would have concluded that the film industry was remarkably stable and that Kodak's dominance was unlikely to be tested for the foreseeable future. Would I have sold after witnessing the dramatic growth of digital photography? Maybe, maybe not. I am not sure. But I do know that I would have reacted late and may have lost money as a result. Is there a solution to this problem? How do I know that ignoring this particular small event will work out in the long run? I don't. Let me restate what I have mentioned before. All investing models have downsides. In my opinion, no investment strategy is foolproof. If you know of one that is, please write a book on it, or better still, email me the magic formula. Our application of GKPI will have Kodak-like downsides, but in my experience, it works well most of the time. And that's the best we can expect of any model. An antelope is swift, agile, and alert and almost impossible to catch. But many do get caught and killed by cheetahs, leopards, and lions. Does it mean that the antelope's design is flawed? Not at all. The antelope is very well adapted to its environment. Not all will live to old age, but enough will, thereby allowing the species to survive for millions of years. We have applied GKPI consistently to every business we have invested in, but not all have prospered. However, as a portfolio, this approach has worked exceedingly well for us. This species has survived. Very well. Chapter summary. Evolutionary theory has taught me that we can reimagine investing by embracing the tenet that the long-term character of high-quality businesses remains unaffected by short-term fluctuations in the economy, the industry, and even the business. 1. Contrary to the expectations of Darwinism, evolution can be faster when measured over shorter periods and slower over longer periods. Bjorn Kurtén demonstrated this phenomenon in the evolution of the teeth of European brown bears. 2. High-quality businesses, too, seem to undergo many changes when measured over days or weeks or months but are much more stable when the period of measurement is years or decades. 3. Empirical data from the longevity of Fortune 500 businesses demonstrate the long-term resilience of exceptional businesses. About 40 to 45% of the Fortune 500 businesses of 1955 continue to be successful for the next 60 years. 4. We have capitalized on the inevitable short-term fluctuations in high-quality businesses to invest at attractive valuations. However, since these opportunities arise infrequently, we rarely ever buy. We are lazy. 5. After investing, we ignore near-term fluctuations because the fundamental characteristics of stellar businesses remain stable over the long term. We never sell on valuation. We are very lazy. 6. We have sold only when there had been an egregiously bad capital allocation or irreparable damage to a business.